All right. Hey, thanks, Dave. Dave's put so much work into this. And hey, hello, everyone. Happy Wednesday. Can't say happy September 11th, but I hope you're having a nice day. Obviously, a lot going on in the world right now. And this presentation, hits home to me. Yeah, my primary focus, is Elliott Wave. As I have evolved as a trader, I'll kind of talk to you about, the other things I use to support, my analysis of trading and investing in the markets. But I guess I've been in the business now for a while, and I'm known as kind of an Elliott Wave guy, and I'm in really good company here in the presentation. So, I kind of consider it like talking, and amongst friends and colleagues, because we're all sort of, looking at a market through a similar lens, which I would say is fairly misunderstood or not wanted to be understood, in that Elliott Wave is, let's all call it for what it is, a subjective practice of market analysis. It's an imperfect filter that we use to look at the price patterns of the market, dissect the collective mindset, look at how the masses who are moving the market, whether they're discretionary traders or they're algos or, computer generated, buy sell programs, how they interpret and discount the expected, market information that's forthcoming. And there's so much going on right now with the debate last night, with the CPI this morning, with the first Fed rate cut since 2020, the seasonality that everybody is talking about. It's making for a very interesting sideways chop fest. We have obviously an AI generation that's booming. NVIDIA is on the forefront, quite possibly, the most remarkable stock in multiple decades previously, and maybe multiple decades to come. We'll see. And people just don't know what to make of it. So, it's interesting. We'll look at some chart patterns. I'll show you what I think my operative wave count is. And it's an interesting time. But I think just on that conversation, and I'm just going off the cuff here, I'll get on track. But I think we all know that, if you're in an Elliott Wave and Fib presentation here, which I believe that's sort of the driving theme, yeah, it's subjective. But what isn't subjective? It's all subjective. Fundamental analysis is subjective. Aside from earnings driving the stock market, which I firmly believe, yeah. But aside from that, on the macro front, where we're going with interest rates, the Fed cutting, are lower rates bullish for the economy and the stock market? Are they bearish? It all depends on what the collective mindset and the interpretation is. Trend lines. Do you buy into trend line support or do you short into trend line support? Which moving average you use? 5, 15, 30, 45, 100, 150, 200, 200 day, whatever, 252. It's all subjective. And I think, the quicker that those other people, I'm not talking to you guys because the quicker we realize that, the pursuit of speculation with, less than perfect information, which is tomorrow's newspaper today, is you've got to trade and invest with EQ, emotional intelligence, not IQ. It's not how smart you are that determines how well you do in the market. It's how well you understand that this is an imperfect pursuit. We're constantly interpreting the data that's coming in, filtering it through the price patterns, and putting ourselves in the best position today with our money that creates a favorable reward to risk situation. And the sooner we can realize that we are using an imperfect pursuit of analysis and trying to understand what's driving the market, the quicker you realize that you guys can set the weight down and you can say, I don't need to know what happens tomorrow or next week to make money. Our job is to thoroughly assess the now with all the information that's available to us, put ourselves in the best situation, and let tomorrow and next week take care of itself. And that was kind of the aha moment for me. And I think Elliott Wave is a wonderful way to do that. But again, the old complaints, you put 10 analysts in a room, you get 12 wave counts and nobody can agree. And it's constantly changing the wave count. What isn't changing? What doesn't change? The only constant in the market is change. You ever watch the Fed Fund futures, CME? You watch how those Fed Fund futures are discounting where the Fed's going to set rates 2, 3, 4, 5 meetings from now. Those things are changing all the time. It's crazy. So I think, you know it, I know it. I think we as a community need to get together and say, and address those who are outside of our Elliott wave community and say, look, let's call it for what it is. It's all imperfect. And I think Elliott wave is one of the most beautiful methodologies out there to understand traditional market patterns that you read about in all the classic technical books. And it gives you expected starting and stopping points, and it helps you understand the mindset of the participants that are driving the market you're studying. And it's a beautiful, wonderful methodology. So that's just my opening thoughts. Tell me what you guys think on that one. I'm watching comments. Anything you got? Comments, questions, insults? Throw it right in there. I've got just a real basic presentation. I'm not doing that much marketing these days. I'm running two businesses. I'll give you a quick, who am I? I run a research business, trading analysis, but I've been more focused on wealth management. So I run an active management RIA, registered investment advisor. So that launched 3 years ago. So I've been focused more on running portfolios. We have two ends. We have active portfolio management as well as financial planning, which is really important, especially for active traders out there to understand, what account you're trading and what it represents to your overall your financial profile, your financial picture, your goals, what you want to do. And as a trader, it's really important that you understand the capital that you have at risk, considering that this is an imperfect pursuit. You have to be comfortable with the risk and what this money means to you to freely speculate and to be able to see your trade plan through to completion, right? You can't be unsure of the money you're trading or investing with, because if you're unsure or uncomfortable with the risks, it's not going to work. It's not going to work. So, all right. So that's me. Let me just give you a quick bio. I will not take the whole hour. I have nothing to sell. I have no, I'll show you where to find me if interested, but nothing to share, nothing to sell, I should say. I'm not going to ask you to go click and buy anything like that. If you'd like to find me and work together, we can certainly arrange that. So I am Todd Gordon. TradingOutLoud.com is the research business. It was founded in 2010. I also run Inside Edge Capital Management, which is the wealth management business that was founded 3 years ago. Actually, we're coming up. October of 21 is our anniversary. I've been doing CNBC. I'm a contracted on-air contributor since 2010. I've been doing that a long time. Before that, I worked on Wall Street for a hedge fund. I was a senior trader at Gain Capital Asset Management. Our sister company, I was the senior technical analyst. I'd write a daily research report that went around the world. I was really early on Twitter, and that was sort of my branch from corporate Wall Street into running my own research business. Prior to that, I was a prop trader in San Diego and LA. 2001 to 5, I worked at a financial publishing company that had a hedge fund and a CTA. So I started out 2-3 years prop trading, went up to the CTA hedge fund that also had a financial publishing arm, and that was a big influence on, what I do today. And then prior to that, I was at St. Lawrence University. I was a Division I ski racer, focusing on trading stock options in my dorm room, the social life of college, skiing, trading, social life. And then when I had time for school, I'd go do that. Got fine grades. And it's funny, one of my customers on the trading analysis side, he reaches out to me. He's like, Todd, you're gonna lose your mind. I'm an economics professor at St. Lawrence, and I've been following you for 2 years. We come up and speak to our classes, so that was pretty fun. So that's who I am. I love the business. It's all I've ever done. I have great respect for, the art of speculation, both on short-term trading, swing, position trading, investing. I think it's a wonderful opportunity that we all have to be able to trade in such cutting-edge markets that are the U.S. markets, especially with the with the value that we're creating out there. I think it's a fun time. I love coming to work. I work at home. I live in Saratoga Springs, upstate New York. 3 kids. I coach baseball. I coach skiing in the winter. Life's good. Life's good. Life's fun. And markets, like this gives us the opportunity to live the life that we want to live. So I'm going to get into Elliott Wave real quick, but just real, top down about the way I approach the markets. My background, I was a prop trader in the equity markets. I had exposure to futures. I had exposure to foreign exchange. And I got an early sense of 2 concepts, which is market leadership. When I was a trader in San Diego at 22, I was prop trading equities. And it would be New York Stock Exchange listed equities. So it'd be IBM, Home Depot. What else did we trade? I think we were trading AIG back then, Citigroup, which I think was Citibank. I don't remember. But we listened to the S&P futures pit. There was a broadcast on the pit of the CME, and we scalp listed stocks based on where the futures were going. So on a 1 minute and 5 minute time frame, when I was 22, I learned the idea of identifying market leadership and then following the markets that were being impacted by that. As I got older and I started trading more markets in my later 20s and early 30s, I'm 45 now, I really started to focus in on the rotation of what they call global macro. So there's 4 major asset classes that are constantly having an impact and impacting the others: equities, fixed income, commodities, FX, and some would argue on a smaller scale that crypto would be the 5th asset class. That's up for debate. The market cap of that is nowhere near any of the 4 that are on the screen right now. So I think it's really important that you understand the impact that particularly bonds or fixed income post-pandemic, post-2022 inflation spike, rates, yield curve has specifically on foreign exchange. The higher our rates went in response to inflation, the more U.S. savings, CDs, deposits would pay relative to the rest of the world. Capital flows would leave other countries, go into the U.S. to make that higher yield. And that's the core driver of FX. So because of the inflation spike post-pandemic and all the fiscal and monetary response to the pandemic and post-quantitative easing, rates went crazy, driving the FX market. The FX market then has an impact on the commodity market. And the 4th man, last man on the deal team, a little Wall Street quote for you, is the equity market. So for the last 2 to 3 years, it's important that you understand what those other asset classes are doing, because they're having a big time impact on what's happening in the stock market. And that's a good thing, because we as an Elliott Wave community, and tell me if I'm wrong, Dave, jump in here, or somebody else tell me, am I accurate that this is collectively an Elliott Wave and Fibonacci group? Am I preaching to the choir, or are we still trying to convert some into our way of thinking? Let me know if you would consider yourself an Elliott. Are you Elliott in training? Are you proficient? Know enough to be dangerous? So I'm assuming it's an Elliott Wave crowd, but let me know. I'm going to look at comments, questions, and I'll kind of adjust as we go. On a scale of like 1 to 5, 1, you're an Elliott Wave newbie. 5, you're, you could give wave counts, to the best hedge funds out there. Where are you? 1 to 5. 1, brand new. 5, you're prolific. How about that? And I'm watching this. Okay. 4, 1s, 3s, 4, 1, 1. Okay. 1, 1, 4, 0. Nice. Okay. So generally I'm seeing about 61.8% of the room is putting them at 1, and 38.2% of the room is saying they're above a 1. Okay, so a pretty good cross section. That's a fib joke. And then the other joke when I give presentations is like, okay, how many of you out there use Fibonacci in your trading? And some hands go up, and generally I say, well, generally I find like 61.8% of the room uses Fib and 38.2% of the room doesn't use Fib, and that usually gets a laugh. Okay. So back on track here, screen 4. Okay, so that's that. So the good news is Elliott wave and whatever, if you're a 1 to 5, you want to have an idea what the wave counts are on rates, gold, crude, copper, crypto, where the dollar is. The dollar's in a big old triangle. I think we're trying to get one more E wave up in the dollar before we drop. You want to have an idea what the impact on the other asset classes are, and that helps you reduce some of the embedded ambiguity of Elliott wave, which I'm trying to make the point early on that that's okay. It's all subjective. You're not Jim Simons at Renaissance running a quant-based rules fund with billions of dollars of infrastructure behind you to automate your trading. You don't have the resources unless I don't know who I'm talking about, right? And there's very few people, and he trades on a very short time frame, right? So you want to have an idea what the other asset classes are doing to help reduce the ambiguity of Elliott, which is not a bad thing. If it was objective, I wouldn't use it. I like the subjectivity. I like those who are able to reason and assess all of the underlying conditions to figure out the most likely wave count. And then we know where there's points of validation and invalidation in the wave count, and then we can go speculate on a trade. We've done all our work. We've covered all our bases. Then we don't have to lose sleep at night. All right. So, the way I do things is I primarily am a stock trader. I start at global macro. I like to know how those 4 asset classes, and, let's call it 4A with crypto. I like to know what's going on. I will then break down into fundamental and technical analysis, right? I like to know where markets are relative to other ones. I like to use something called relative rotation graphs, single chart analysis within the fundamentals as I do trade individual stocks, both on a short-term speculation basis, and I run individual equity portfolios at my wealth management business, Inside Edge. I do then drop down into understanding how the company's doing with earnings as well as future expectations, because that's important to drive institutional order flow. So this is my kind of top-down tree of the way I look at the markets. So, you want to find, I think, how those 4 asset classes are working, do technicals of each one, how they're doing relative to each other, single chart analysis, fundamentals, look at valuation, analyst expectations. I find the best sectors that are rotating in, which right now, the 11 sectors that make up the American economy, tech is rotating out. And we're getting a move into value, which we'll talk about. So value, financials, to a lesser extent, industrials, real estate, utilities, staples, healthcare. So that's what we're seeing. Materials, tech and consumer discretionary are not doing much. Communications are staying solid, interestingly. But you want to know how sectors are rotating, find the best industries within sectors, and then find the best stocks to trade. It's a big process. But again, I'm running millions and millions of dollars here, where, I'm not going to, just put a finger in the air and just find the best stocks that I read about on, on some publication. So yeah, I do a lot of work, but, I'm just kind of showing you who I am at the top. I'm going to skip through this fluff. So let's talk about Elliott. I mean, you guys know this, right? It's based on Ralph Nelson Elliott back in the 30s, picked up the work of Charles Dow. And Charles Dow, part of the Dow theory was the markets move in phases of 3. Early accumulation, you get a setback in a wave 2 as those bears who watch the market decline sit back and say, yeah, I knew we're going to new lows. Then you start to get shorts covering, breakouts above the recent high, momentum comes in, fundamentals improve, sentiment improves, which is widespread participation. And then you get a little bit of another sell-off, usually a little bit more complex than this. And then you get a final push-up, which this arrow should be here. This is the distribution phase. The process sets up, like you get a pretty sizable correction, and then the process begins again. So it's accumulation, widespread participation, distribution, and then the process begins again. Ralph Nelson Elliott took Charles Dow's work and went so much further than that and gave us the beautiful methodology of Elliott wave. Now it's been handed down and interpreted and changed because he didn't give us all the information because he really came about Elliott in the latter part of his life when he was done traveling based on his assignment from the presidential administration to go down to Latin America. He was sick in his later years, and he really came about on Elliott Wave. So Elliott, in the 1930s, Ralph discovered that stock market prices trend reverse and recognizable patterns. The patterns are repetitive in form, but not necessarily time and amplitude, says my friend Bob Prechter from Elliott Wave International. My interpretation, they help you dissect the collective mindset of market participants who drive market prices and observe how they anticipate, digest, and react to varying market factors, including fundamental, geopolitical, technical. Often you're observing their cognitive dissonance. Okay. I'm going to skip past that. If you haven't read the Market Wizards book, I highly recommend you read this book. You read Reminiscence of a Stock Operator, wonderful book. Trading in the Zone, global profiting from global market intermarket relationships from John Murphy. Darvis's book. I think that's pretty much all you need to be a speculator. All right. So Tudor Jones, who's global macro hedge fund manager, made billions of dollars, has donated billions of dollars to his Robinhood Foundation. Is quoted in the original Market Wizards book saying the reason Prechter, who is Bob Prechter, who is the modern day interpreter of Elliott Wave, which we'll talk about, the reason he's been so successful is Elliott Wave theory, and this is the key, allows one to create incredibly favorable risk-reward opportunities. This is the same reason I attribute a lot of my own success to the Elliott Wave approach. So it's Tudor, who's now a billionaire, saying it's not Elliott Wave's ability to predict the future. It's embedded risk management factors with the patterns and guidelines that we use in the Elliott Wave theory to help you figure out where a market should reverse, where support should come in, where resistance should come in, points of ruin, points of confirmation. That becomes your trading game plan. Again, it's not about predicting the future. It's about assessing the now. Okay. Soros, even in the New York Times, Soros said Prechter's reversal proved to be the crack that started the avalanche. So this is Soros in 1987 saying Elliott Wave not only called the 87 crash, but caused it. And there's the source right there. So I've worked with Elliott Wave International for years. I'm friends with Bob. I have a differing market outlook than him. I have a great amount of respect for him. I think he's incredibly intelligent, but we have a differing views of the interpretation of the market. So we can just leave that one there. So, and I'm talking big picture, and we'll get into specifics. I'll show you where I think we are in the market. I'm just talking big picture if that's okay. So let me just keep questions up. Yeah, and Michael, and that's exactly bit too much lingo versus charting. See, that's exactly why I'm getting away from the education of new traders who just want to look at charts. That's why I'm getting away. The key to long-term success and profitability is in the mindset. It's not in the charting setups. So I'm not here to sell anything. And I am doing, again, I've put my entire career into this, now running money, and I'm sharing with you everything that I have to offer, my entire career, in terms of the mindset and the approach to ensuring that you don't blow up, that you have long-term success in this game. This is more important than chart setups. I'm sorry to jump on you, but that's the reason a lot of guys and girls don't succeed, is a comment just like that. Okay. Human population and real productivity growth. So longer term, Elliott Wave is, it's often associated with a lot of doom and gloom. And it's important that we understand that. As the population expands, our total productivity increases, right? So at the biggest degree of trend, Elliott Wave is studying our collective human progress and productivity. The better we do as a global economy, which I understand there's sort of divesting from overseas. We're having something called reshoring and onshoring. We are becoming less of a global economy, but still, it's still very much at work. At the largest degree of trend, we are in a 5-wave move up. So in fact, Elliott wave, when you hear someone say it's always doom and gloom, it's always bust, not boom, not true at all. At the largest degree of trend, it's a 5-wave move up. And unfortunately, at the largest degree of trend, it will end at some point, but that's when either a comet hits us, the robots take over, and it's all over anyways, right? So at the largest degree of trend, it's bullish. And after that, it doesn't matter because it's all over anyway, right? So just keep in mind that Elliott wave is very, very bullish. This is a long-term wave count from a prominent Elliott wave organization who is calling for a significant decline. I don't agree. I don't agree. This is my long-term wave count. And I think where we differ is a lot of Elliott wave organizations will put the wave 3 of a 3 back here during the Industrial Revolution. And if you look at the structure of this wave count in here, it's very choppy. There's no huge, massive gains. There's not a lot of separation between the corrections. I would say it's more proper, it's more likely to call the third of a third during the 1982 to 2000 initial inning 1 tech rally. We set back in the tech pop, rallied up into the housing crisis, global financial crisis. Now we're inside of wave 5 of 3. The good news is, I think once this trend exhausts itself, which I think we have a lot higher to go, we then will move into a wave 4 that will square up against the 1929 crash. But if you look at the percent gains that we've seen post, this is World War II, up into the stagflationary 60s and 70s, and I'll show you on the next chart. If you look at percent gain here, we are very early in this current rally. But using the guideline of alternation in Elliott wave, once we get into this 4, if wave 2, which was the 29 crash, was very sharp and directional, wave 4 should be very choppy and sideways. And we're going to have a series of 3 4s, 3 4s. Once that's done, there could be in the back half of this century a lot of slop and chop before we eventually move higher in wave 3, go back in 4, and then move up in 5. Okay, so specifically, here's one of the charts that I share with our clients. This is the long-term Dow count. So again, the way I look at this is 1, 2 into 1942, which is the start of World War II, up in 1. I think that the stagflationary 60s and 70s was a precursor to a wave 3. I don't see this as wave 4. When you get a real sideways, not a lot of retracement, chop and slop, that is foretelling a lot of coming strength in the market. And that is leading into your tech run of 2000, tech pop, housing run, GFC. Now we're coming up in 1 and 2 from 18 and to the pandemic. I think we are inside of wave 3 that in the coming decade or so, we move into the 100,000 mark here in the Dow. Okay, and if you look at the angle of ascent here in the Dow, we have a long way to go. And it doesn't look obnoxious. It doesn't look fantastic. It looks fairly reasonable. Okay, so I think this is interesting, and there's a lot of debate within the Elliott wave community since 2009. I am very much of the belief that the 2018 into 19, 20 pandemic, this was the largest correction in depth and duration that we've seen since the 09 lows. I think this correction is of its own degree, meaning it doesn't square up with anything here in 15, 16, or here in 11 and 12. This has to be wave 2 in my mind. Then we did another 1-2. So yeah, we're in a little bit of a rotation out of value or out of tech and into value right now as we're breaking above. But I think looking at intermediate 1 and 2, 100% price projection is the 75,000. And if you look down here, you're talking 2027, 28, 29 in the next 5 years on the way to 75K in the Dow. Yearly chart of the Dow. This is the S&P. This is actually really interesting. So this was 2020 yearly candle, 21 yearly candle, 22 yearly candle, 23 yearly candle. Look at the highs over the last 3 years on the yearly, 4,800 in the S&P, right? Where are we now? We're above it. So we've broke a triple yearly top in the S&P on a smaller degree, wave 3. Once we move up, we'll set back in 4, then go up in 5, so on and so forth. So I think, yeah, over the next decade or so, I think we have, I think we should be able to get to 10,000 S&P, 11,000, 12,000. You have some fib resistance up here from 8,700 all the way to 16. And if you just look at what's actually happening here in the price chart, forget about everything you hear, all the scare tactics out there, everyone trying to sell you something, get you to click on something, get you to subscribe. The way they do it is by selling fear. Fear is a much more powerful motivator than greed. And I think this is where Elliott is so beautiful in that you can step back, tune out all the noise, put on some good music, forget about everything, and really get lost in the charts. You'll find market turning points and market trends that others just don't see. Okay. So, again, end of 22, they were telling us 70% chance of recession. Everything's burning. All right. This was a account I was looking at. I was like, okay, maybe we drop down into end of 22, early last year in 23, down into the 3,300. This is an account I shared with our students. I put this up on Twitter. And as we moved into the late 22, early 23 lows, I was like, okay, what have we seen in the decline in 22? 3 up, 3 up, 5 up. That's different. Maybe we have a 5 up. And I tell you what, the bearishness in here was rampant. And it's the collective, it's the fear that, again, advertisers, media, traditional and social media influencers are trying to grab you and scare you. They were hard at work here in 22 and 23, and that wound up being the low in the market. We rallied up nicely at the end of 22, set back in 23, and from there, we're off to the races. And I think this was one of my favorite tweets that I got in response to that 5-up chart, and I think it's really important. And he says, I love that no matter the market, this is always a reaction from the faceless crowd. Bulls get no respect. They're reckless, lazy, and out of touch with the reality and the facts. On the other hand, bears are hailed as being prudent, responsible, carefully, scholarly, and I would also say mostly not rich. Okay. So, I think it's important, and we'll get into wave counts here in a little bit, but this is one of the tools that I mentioned in terms of rotation. I like looking at these relative rotation graphs. They're wonderful. Basically, what they're doing is visualizing sector rotation or some group of markets rotating around a central benchmark. The charts in real time, I can show you how they work. They literally rotate for the most part on a clockwise fashion. As you move up and to the right, you're picking up relative strength. As you move higher on the chart, you're picking up relative momentum to the benchmark. And what we're doing is benchmarking against the S&P 500. And what happened back there in 2023 was we got the growth ETF, Vanguard Growth. That's all your large cap tech rotating in favor as the Vanguard value is rotating out of favor. Last year, Q4 23, we got a nice hook up. And what I'm doing over here with these stats is as these two rotate mostly against each other, value and growth, these are the flagship value growth ETFs. Once you get a growth ETF moving into this top right quadrant, which is the leading quadrant, that means we have the higher this number, the greater the relative strength to the benchmark. And the higher this number, the greater the relative momentum to the benchmark. Once you get growth moving into monthly leading, each one of these dots is 1 month of trading. So you're basically looking at, 18 months or so, 12 to 18 months of monthly growth ETF to the benchmark. You rotate it in from the bottom lagging into improving into leading. Once you get a move into leading, how long does it stay there? And I went back and looked at the history. And as the growth ETF is rotating in, it did so in 08, 14, 17, and we just did it in September 23. These are the amount of times that the growth ETF remains on the right-hand side, which again is showing relative strength and relative performance to the S&P 500 benchmark, which is pretty heavily, cap growth influenced because of its structure. So the growth ETF will stay there for 58 months, 30 months, 57 months. And when the value ETF switches, value goes on the right side, which is outperformance, and growth goes on the left, on average, it lasts 9 months, 11 months, and 16 months. So we rotated in September of 23. It's been there now for 12 months. Remember, the last 3 times it was there 58 months, 30 months, 57 months. We're now there 12 months. So here's where it is now. The growth ETF started here in September 23, and we're now dropping. We've been losing relative momentum in growth. We just over the last 2 months started to move out of leading into weakening, but growth is still very much on the right-hand side, and value is very much on the weaker left-hand side. This is the weekly. So each one of these dots represents 1 week. Yeah, this is a much shorter time frame than this monthly. The value is threatening to go into the right side, which is outperformance to growth. Growth is threatening to go from the right to the left. I'm very interested to see how this occurs. Does value make a full rotation over, growth or full rotation out? And where will value start to make this move, pushing growth further out of the leading position towards the XY axis here, or towards the east-west divide? This very much influences the wave count that you look at in the index. If growth stays on the right side and we start to see a little bit of a hook up in growth, and on the month we stay on the right, you want to favor bullish wave counts in the market and continue to be bullish. If we continue to see growth rotating out, I'm going to be looking more towards the bearish side, and we're going to need to be protective for the longer term outlooks. Okay. Now, as we break down into smaller stuff, rather than just growth value, you can see we have small cap value, we have mid cap value, we have mega cap value. All of these guys on the weekly, including even small and mid cap growth, are rotating in. This is the weekly. What's rotating out? Only one, mega cap growth. That looks like my camera's freaking out. That's okay. I'll turn it off. Actually, let me just give this thing a quick poke. Give me 10 seconds. I think I have a bad HDMI connection. Hang on. Yep, that fixed it. So the point here is the only one that's rotating out is mega cap growth. Even mid cap growth and small cap growth are trying to rotate in along with all the value segments, small, mid, and mega. So what that means is large cap growth is taking a back seat, but the smaller and the mids are going in along with value. The stock market breadth is broadening. So the market's at this sort of juncture. It's at this junction. It doesn't know where to go because we're losing the leadership of large cap, mega cap, mag 7 growth, but everything else is rotating in. So the market is trying to decide, can we continue to rally without the mag 7 leading? And that's creating a very challenging environment that we're in right now. Okay. So I'm going to skip all this. This is just whatever. Okay. So let's take a look at some charts. All right. So markets are down. Where do I think we are? Here's the S&P. Here's 22, 23. So what's interesting, and I'm talking to you probably 3s, 4s, and 5s in the Elliott Wave community. There's a few people in the world that I trust on the Elliott Wave side, and I've spoken to Prector about it. I've spoken to some guy who runs Elliott Wave for some of the biggest hedge funds in the world. I know him. I used to be his neighbor. And I can't get an answer on this. And again, I'm talking to you 3, 4s, and 5s. The move off of the 22 lows, I have it as minor ABC running flat. The percent distance traveled in this was only 7%. Then we rally up in 1, down in 2. This is a lesser degree wave 2 correction. This degree is what they call the minute degree. This correction was larger in percent travel, which is 10.9% compared to this. I don't think that should be valid. Ralph Nelson Elliott never told us anything about the actual distance traveled in a correction of a lesser degree that is contained within its parent, motive wave. He said there's something that called the right look. So the correction has to, corrections have to be somewhat in proportion to its same degree trend waves, but they never talked about that. And R.N. Elliott never gave us that. I have a problem with this, that 2 of a lesser degree is so much bigger than this smaller degree 2. That being said, then we go up in 3, again, kind of a small 4. I don't like the size of this 4 compared to the size of this 2, but this is what the market's backing us into, okay? In fact, let me just make this a weekly chart so it's not so squished up. So if this was completed minor 3 by way of the 5-wave move here, the move down so far in A, which we'll get into, is not motive impulsive. It's a 3. On top of that, we just, in the S&P, rallied all the way up, double topped. If this is the start of a new downtrend, here's how downtrends often begin. 5 down, 3 up. That is not this. Okay. On top of that, the 3 up usually goes to some 61%, maybe as high as 78% rally. We didn't get that. We didn't get that at all. So I'm thinking, with the bearish sentiment out there that I was trying to talk to you about in the opening, combined with the sector rotation, yes, we have value trying to rotate in on the weekly. We have growth trying to rotate out here. Where the heck is it? We have growth on the monthly. This is much more important. While this guy is further to the right, over the last 10 months, 11 months, growth is massively outperforming value. We're just starting to get a hook on the monthly. The weekly is trying to nudge the monthly in. This is a very interesting east-west divide in value growth. This is going to have a big impact on where and what wave count prevails here. If we can get growth to stay on the right side of the RRGs, I feel pretty strongly about this wave count. Here's the daily. This on the S&P, this is not a 5. This is a 3-wave move. Plus, On any good retracement, you really should stay below what I call the retracement of last resort, which is the 786. If you don't know how to do 786, you take the square root of 618, it's 786. And often what breaks the 786 goes to the 1.272 extension. How do you get 1.272? You take your golden ratio 1.618, you square root it, it's 1.272. So if we can somehow stabilize, eventually I think we're going to go up and hit the 1.272 extension. But is the operative pattern right now in this market, combined with the crazy seasonality, combined with all the bearishness out there, how our way of life and the outcome of this political election is going to determine the fate of America, that's such bullshit. It's just another election. Yeah, there's some scary tax plans and capital gains in there, but it's just another election. It's really not going to have that big impact on the market as much as they want you to believe. So for all those reasons, I think the triangle is the most operative pattern. Now, the problem with the triangle is, in order to be bullish before or after the election, maybe into the seasonally strong period of December and January, we have to get weaker in the near term before we can get stronger in the long term. So I'm really preparing my research people and my investors on the wealth management. Like, it could be really, really choppy. And the thing with triangles is, you want to monitor the frustration of your fellow market participants. Like, as people get more and more frustrated with the false breakdown in C, the false break up in D, the false breakdown in E, as soon as enough people throw their hands in the air, that's when the triangle breaks. Let me just make sure I'm sharing my screen. Share, share, share. Yes, I am. 4. Okay, good. Sorry. Sometimes I get talking and I'm not sure my screen. So as soon as enough people throw their hands in the air in frustration and say, forget it, this market's never going to break out, that's exactly when triangles go. I just don't like how cute it is by the length of the triangle compared to distance traveled in wave 2. We want to do a 4v2 time comparison, how it really lines up right around the election. Where's my 4v2 times? There we go, down here. So we have 100% 4v2 in terms of time on October 21st. We had 23% 4v3 time retracement on November 6th. So you've got a little time, a pair of time levels here, and then you have another wider zone out here. You have a 38% time on January 15th and a 200% 4v2 on January 24th. So you kind of have a pair here and you have a pair here. I'd be shocked if we really chop that much into the new year, but we'll see. We'll see. The NASDAQ matches up with this fairly well. The problem with the NASDAQ is, actually, there's no problem with the NASDAQ. I'm wondering if the NASDAQ is doing B of C, and the C wave may go down. We came close to the 618 retracement of B. We have the 786 retracement of B down here. Within triangles, you want to do alternate price projections. So what that means is you want to compare C using a fit projection against A. So what you'll do, I use Motive Wave software. I've used it for over, 12 or 13 years. C versus A, which is right here. Come here. Here it is. The 61% A versus C price projection is right on top of the 786 price retracement. This is crazy. 17,937, 17,943 in the NDX 100. this is a really, really key zone. So in order, again, to be longer term bullish, we have to be near term bearish. So I'm thinking that this rally, and I'm going to spin over to NVIDIA here in a second, even though NVIDIA, I think, is tracing out a really nice triangle, the indexes, and NVIDIA is later in the triangle, the indexes, I think, are calling for another decline. You want to see people get really bearish down here, sentiment to sour. And then if we can hold this zone of support down around 18K in the NDX, then you're looking for D wave rally. Then you're looking for E. Then you're looking for people to really get pissed off, get frustrated out of the market, and that's when she goes, right? So I'm thinking that this might be the path forward. NVIDIA is interesting. NVIDIA, the count that I'm watching here is that we are doing this. Let me do weekly first. I'm thinking in NVIDIA back to 2022 that we did one nice little ABC down in two, a nice three-wave motive impulsive in minor three. Same thing, triangulation. The bearishness is insane in NVIDIA. The bearishness is insane. I'm going to talk to you about that in a sec. The triangle, I think, is happening. You could count this as a five-wave move. It's possible that it's 1, 2, 3, 4, 5. I can see it. We rally up in B. We go down in C. Now, what's interesting is, remember I said the alternate waves in a triangle, A versus C, B versus D, E versus C, should be related by a 618 relationship. Well, 618 of C versus A in NVIDIA was at 100.03. 786 retracement was at 98.16. This is a really good zone. As I mentioned, if you paid attention, the NASDAQ, I'm looking for B of C, which means the NASDAQ's got lower to go, maybe, based on this. If the NASDAQ has 700 points lower to go from 18,007 to 18, this NVIDIA wave count is not going to work. It's not going to work. So I'm wondering, maybe this is B and we're going to have a deep, deep C wave, but we have to stay above wave count validation here at 90.72. This is your value zone. Okay, this is your value zone in NVIDIA. I don't know what the future holds. Nobody does. But can we identify asymmetric risk to reward situations where we can risk, even if we get in today, we're risking 18% to make I'm trying to build the build the tension here. Minimum 160% minimum. These are bare minimum upside fit projections for wave 5. Minimum. And I could do some other fib studies in here. Okay. I don't know, but I'm trying to match up the wave counts. Now, combine that with the bearishness that we've seen in NVIDIA. The earnings report was like, I knew NVIDIA earnings report was going to be sort of a sideways, whatever. I sold upside calls. I've got a lot of NVIDIA stock in our wealth management portfolios. I hold it personally. I sold upside calls and bought downside put spreads, just to kind of hedge out the position. So it was so highly anticipated. I'm going to launch another platform here real quick. Copy. 10 more seconds. It was so highly anticipated. And here's the dynamic at work in NVIDIA. Let me do this. get rid of one chart. Okay. NVIDIA, the earnings report was awesome. Okay. What happened with this quarter in NVIDIA, aside from the Blackwell uncertainty, is NVIDIA is now comparing in Q3 of this year compared to Q3 of last year. And what happened was between Q2 and Q3, NVIDIA, I remember this, said, listen, Wall Street has us at 7-8 billion next quarter. You guys are off by 50%. Next quarter, we're going to make 10 to 11 billion. And everyone just got absolutely floored on that. They guided up to 10 to 11 billion, and then they reported 13 billion, which was 101% year-over-year growth. Their EPS quarter, like the next quarter, went from 11 cents to 27 cents. And that's where this whole thing began. So that was in Q2 to Q3 of 23, which was right here. Okay. This is where they said, all right, you guys are off. We're now comparing, NVIDIA is now comparing year over year. This number is only up 151% because we're now comparing when NVIDIA went into its growth phase. The street is used to looking at 566%, 477%, 454% EPS growth, revs, 101, 205, 265, 262. Oh man, only 122% year-over-year growth because NVIDIA is now in the hypergrowth. It's now comparing against the hypergrowth phase. So the shock and awe of NVIDIA is over. You know, we're still only growing 100% year over year. It's insane.